Hello, everybody. Thank you for joining us in our fourth and final session of today's Cherry Beckert 2025 Not-for-Profit Virtual Conference. Again, for the fourth time, for those who are joining us, my name is Jeanette Schwartz. I'm a partner in Cherry Beckert, and I am the leader of the not-for-profit outsourced accounting services here at Cherry Beckert. This session, as you heard, is one CPE credit. You must attend for the full 50 minutes and respond to at least 3 of the polls to get credit. Now, who are we going to hear? It's my time to introduce and the topic. I'm very excited to hear this one. In this session, we're going to hear a practical overview of endowment accounting, including compliance with GAAP and UPMIFA, which is the Uniform Prudent Management and Institutional Funds Act, donor restrictions, net asset classifications, underwater endowments, and required disclosures. We will also highlight critical policies that organizations depend on for managing those endowments. I am super pleased to present 2 of our senior managers from our Accounting Advisory Services group, Jason Sturdivant and Rob McCabe. And with that, I'm going to turn it over to them. Enjoy.
Thanks, Jeanette. I'll start us off. So we're here to talk about demystifying endowment accounting, navigating UPMIFA restrictions and financial reporting. We can go to the next slide. My name is Rob McCabe. I'm a senior manager in the CFO advisory practice. I focus on commercial and not-for-profit entities. My background is in audit. Spent 7 years as an auditor, left as a manager, and was a director of financial reporting at a not-for-profit in Washington, D.C. And then I was there for 3 years before coming over here. And again, I focus on the commercial and not-for-profit side. Jason, do you want to give an intro?
Yeah. Thanks, Rob. So I'm Jason. I'm a senior manager also in the CFO advisory service. I work exclusively with not-for-profit organizations and organizations of higher education or institutions of higher ed. I've been working with nonprofits for almost a decade now. Before that was working in higher ed. So excited to share today's topic with you all. Hand it over to you, Rob.
All right, if we go to the agenda, I know Jeanette briefly went over this, but we'll differentiate between donor restricted and board designated endowments, explain their impact on net asset classification, key financial statement disclosures related to endowment funds, investment return components, spending policies, the application of UPMIFA to determine prudent spending and treatment of underwater endowments. We'll understand best practices and tools, and then we'll end with a Q&A. So overall, the objective is to demystify endowments, that is to provide you a baseline knowledge of endowments and see through all the noise and the guidance out there. So why do endowments matter? Well, they provide financial stability. They provide predictable and sustainable sources of income, reducing reliance on volatile funding streams. They provide resources that allow institutions to plan for decades, not just fiscal years. They provide access and opportunity, for example, for the higher education folks out there, scholarships, fellowships, financial aid. So they make education services accessible to more people. And they provide innovation funding, seed money for new programs, research, initiatives that might not attract immediate external funding. In the same vein, they support mission alignment, community engagement, and upgrades to critical infrastructure like technology and administrative operations. On the other end of things, they require responsible stewardship. They required compliance with GAAP, UPMIFA, the creation of and compliance with spending and investment policies, and ongoing monitoring and strategic planning. If we go to the next slide. So here's a nice little graphic and that rings true to what I just said on why these matter. You can see that of the 645 higher education institutions, almost half was spent on student financial aid, academic programs, research, and facility positions. So you can see it provides a net social good, and so hopefully we can clarify some of the compliance aspects about endowments with this presentation. So what I like to do is always look at real life examples. You can look at the codification, read line by line, but it helps to see a real life example. So I pulled the top 20 colleges with the biggest endowments, and of course, Harvard is at the very top with almost a $51 billion endowment. And because Harvard has federal funding, they submit their audited financial statements to the single audit federal audit clearinghouse. So this is available for everybody to pull. It's a great tool to do research on how to approach a complex topic and disclose it on your financial statements. So you can see Harvard on the right here, and the 50 billion ties directly to that number on the bottom right and the little box I put there. So here you see that the endowment is condensed to a single line item. If we go to the next slide, we see the note to the financial statement where they further break out the composition of the net assets. They talk about spending policies, endowment funds, and among those, the composition is perpetual endowment funds subject to distribution, and the board designated endowment funds. So if we go to the next slide, and this will be basic for a lot of you, so bear with me, but how a net asset is created for a not-for-profit institution when a transaction comes in, and yes, so the PDF will be available, I believe. When a transaction comes in, a not-for-profit first must determine whether it's a reciprocal or non-reciprocal transaction. Reciprocal being that both parties receive commensurate value. And if that's the case, then none of the 958-605 guidance is applicable. It's a 606 transaction, which is revenue for contracts with customers. After that determination, you go further down the flow chart, determine if there's a donor imposed condition. You could spend a whole presentation talking about this and the nuances with that. That's not the purpose of this presentation, so we'll continue on. And then, is there a donor restriction present? So that's where you determine, is there a donor imposed restriction, which on the next slide we'll define. A donor imposed restriction is one in which a donor stipulation that specifies a use for a contributed asset that is more specific than broad limits resulting from the following: the nature of the not-for-profit entity, the environment in which it operates, the purposes specified in its articles of incorporation or bylaws or comparable documents for an unincorporated association. I've also highlighted or italicized and underlined some relevant language relating to endowments. Excuse me. Other donors impose restrictions that are perpetual in nature. For example, stipulating that resources be maintained in perpetuity. Laws may extend those limits to investment returns from those resources and to other enhancements of those resources. So Jason will talk more about those laws, which we mentioned earlier is UPMIFA. And we go to the next slide. So what is an endowment by definition? FASB states that it's an established fund of cash, securities, or other assets to provide income for the maintenance of a not-for-profit entity. The use of the assets of the fund may be with or without donor restrictions. Endowment funds generally are established by donor-restricted gifts and bequests to provide a source of income in perpetuity or for a specified period. Alternatively, a not-for-profit's governing board may earmark a portion of its net assets as a board-designated endowment fund, which we define on the right, which is an endowment fund created by the governing board by designating a portion of its net assets without donor restrictions to be invested to provide income for a long but not necessarily specified period. So an example of this would be like a rainy day cash reserve fund, which I helped a client establish. They just wanted a six months of cash runway just in case the economy turned, which turned out to be pretty prescient, and we got the investment spending policy together, and it officially went through the board about 2 years ago. So on the next slide, we have a little graphic on how
There's a good question in the chat about the difference between a board designated endowment and a quasi-endowment.
I they're the same. Board designated is the same as a quasi-endowment fund.
Yeah, sometimes one may be a little bit broader than the other, but functionally they operate the same.
Yep.
Good question.
So how is an endowment created? This is a simple graphic, but we use Cherry Beckert Foundation as an example. Let's say a donor pledges or provides financial assets with the donor imposed restriction to invest that money and preserve the original value of that donation. The investment return on that donation may be used for purposes of A, B, and C, 90% of that investment income, and the 10% in excess can be used for operations. So the donor will give the money to Cherry Beckert. Cherry Beckert will invest that money with the custodian, and then according to their investment policies and spending policies, they'll put it in securities like the S&P 500 fund, whatever the risk profile to preserve that corpus and provide the return according to their policies and the donor stipulations. And then the excess of that will be spent according to the donor's wishes on A, B, and C, and then 10% for the operations. So at a high level, most basic level, that's how an endowment works. And then some endowment terms that we throw around here, corpus and principal is the original value of the donation. So in the previous example, it's let's say it was $100, their original donation. That would be the corpus. Any investment turned in excess of that is subject to spending policy. Investment return is exactly what you would expect. It's dividends, interest, realized and unrealized gains, and it can be presented net of investment management fees. So with that, we'll go to our first polling question. Does your organization have an endowment? And I think Eunice, you'll let us know when everybody's responded, right? Okay, so 73% have said yes, that's great. 3% said not sure. If you're not sure, feel free to reach out after this presentation or put it in the Q&A and be happy to help you sort that out. So now we'll get into the guidance. So I started off with the basics here, classification of net assets, and then later the second box. Yeah, we can go over the spending policy. Information about self-imposed limits is also useful, including information about voluntary resolutions by the governing board of the entity, such as resolutions to designate a portion of its net assets without donor restrictions to function as an endowment. So that's talking about board designated endowment funds. And you can see that Harvard properly breaks out with and without donor restrictions, but condenses endowments to a single line item. They elect to break out the composition of those net assets within their notes. If we go to the next slide, here's some endowment specific guidance. It's just a reiteration of the previous slide. You break out with and without donor restrictions. And just for everybody's benefit, many years ago when I first started out as an auditor, there was a 3-column format: unrestricted, temporarily restricted, and permanently restricted net assets. I thought that was a better way of presenting this type of information, but FASB in like 2019, 2020 implemented 2016 ASU 2016-14 and just changed it to a 2-column approach. So now it's just condensed to with and without restrictions. In the second box, go back. In the second box, when classifying a donor restricted endowment fund, consideration shall be given to both the donor's explicit stipulations and applicable laws that extend donor restrictions. Investment return generally is considered free of donor restrictions unless its use is limited by a donor-imposed restriction or by law. I just want to point that out there because it's referring to UPMIFA, and Jason will cover that later. If we go to the next slide, I just wanted to show all the faces of the financial statements where endowments touch. You'll see investment income, changes in net assets, and then the statement of changes in net assets, which includes a mandatory reconciliation of beginning and ending endowments. So if we go to the next slide, we're into the disclosures now. A not-for-profit shall disclose information to enable users to understand all of the following: net asset classification. We saw that Harvard does that on the statement of financial position. Net asset composition, they do that in the notes to the financial statement. Changes in net asset composition. In the previous slide, we saw the statement of changes in net assets. Spending and investment policies, they also include in the notes to the financial statements. You also, if you're 73% of this room has endowments, so I'm sure you're familiar with the gigantic note that's included. A lot of that's due to the interpretation of UPMIFA and the underwater endowment policies, policies around spending and investments, return objectives, strategies for employing the return objectives. If we go to the next slide, it also mandates a reconciliation, which I touched on earlier. So I added that to the side here with the statement of changes in net assets. Sometimes there will be a stipulation to preserve the corpus in any inflation effects on it. So sometimes CPI will be factored into the preservation of the corpus. And then for each period in which a statement of financial position is presented, you have to disclose the fair value of the endowment fund, the original gifts, and the deficiency, which Harvard has to the right here. So if we go to this next slide, here's the note to the financial statement. Just want to provide that. The PDF will be included, but if not, I think the Federal Audit Clearinghouse is a great tool to pull for any accounting topic, not just endowments. It's like Edgar for our public clients. Anytime we come across a complex transaction, that's a useful tool to see how publicly traded companies are treating a transaction, how they're disclosing it, how it's presented. Same thing goes here with this single audit search in the Federal Audit Clearinghouse. I do it all the time, just see how these large institutions are handling all these disparate types of transactions that they run into. And Harvard has a great example here for endowments. So I think their endowment note is pretty short and concise compared to what I've seen in the past. So you'll see that, yeah, they have the distribution policies on the bottom left and the underwater endowment policies, the composition of the net assets. They have everything in this note. So it's a great example. And if we go to the next slide, that's our second polling question. What is the size of your organization in net assets?
I know there's been a couple, while you're answering this, there's been a couple questions in the chat, at least that Rob and I are seeing, that we'll either touch on the slides or maybe at the Q&A at the end. In case they're organization specific, we can deal with that then if we don't cover that in our presentation, but we'll try to get to everything in this session.
Yep, cool. So it's firmly middle market. We have 92 small business and a couple big ones. So it's like a perfect bell curve. So
That's right. Yeah.
yeah.
Okay. All right. Well, thanks, Rob, for that overview. So in addition to financial statement reporting compliance, one of the things we want to talk about is UPMIFA. Rob touched on this a few times. We want to talk about what the essentials are. Even basic things like, if you don't know what we mean by UPMIFA, what are we talking about, right? That's a handy acronym. It stands for the Uniform Prudent Management of Institutional Funds Act. So this is something that was published in 2006. And it was intended to be kind of a guideline for a lot of state legislatures to enact in their local state. And it really guides how organizations, institutions, foundations are to manage institutional funds, which commonly we refer to those as endowments. So this is the law of most of the land. This is enacted in 49 states, the District of Columbia, and the U.S. Virgin Islands. So you can see on this map to the right, Pennsylvania and Puerto Rico are the odd ones out. It's unclear to me why. I think, if I remember, once upon a time I heard that the Pennsylvania legislature just sort of dragged its feet long enough that now they're just operating on the predecessor to UPMIFA. I think it's UMIFA. So it's not entirely different from UPMIFA, but it isn't specific. That said, although this is a uniform act to try to make sure there is consistency across the country, each state does have its own version that might vary. So really, if you're a foundation, if you're an NFP, depending on where you operate, you should really get a clear sense of what your state laws are, local regulations, because there are specifics that vary from one location to the next. So if you have questions about that, we can assist as needed, but do make sure you know that what MIFA looks like in your state could be different from maybe if you worked at a different NFP in a previous state. Other things to note, right? So here's a snip of the front page of the act that provided guidance to a lot of the state legislatures. Really, the fundamental concept of MIFA is that nonprofits must ensure that that endowment corpus balance preserves its purchasing power over the long term, right? So if somebody gives you a gift of $100,000 for your endowment, it is your job as the NFP, it is your job under the law as an NFP to ensure that that purchasing power over the long term is maintained, so that $100,000 stays purchasing the equivalent of $100,000, even though you're not touching that money. Similarly, it requires that there is an investment committee that has oversight into an organization's endowment return, its risk profile, its asset allocation, all the kinds of things, right? If you get money and you're investing it, you need to have really clear guidelines on both how you're investing it and who's overseeing that investment and managing that activity on a go-forward basis. And then also just avoiding imprudent spending. So one of the things we've talked about a little bit obliquely is the spending policy. So if, for example, your historical return on your on your investments for your endowment pool is 7%, but you have a spending policy that's 8%, that means over the life of your endowments, you are spending more than those endowed assets are earning, which is imprudent. And often it's not usually a 1% difference, it's usually much larger than that, but you're required by law, right, to avoid that in order that you can meet that fundamental concept here that we talked about at the top, that you have to ensure that corpus balance preserves its purchasing power. Now, if you don't maintain that purchasing power, your endowed gifts will go underwater. That's what Rob talked about. So this is where your spending exceeds the earnings on the endowed gifts. So you invest $100,000 into the stock market, you are spending more than the return on that, but you're not supposed to really dip into that $100,000 original gift that you were given. That corpus is to remain fixed over the life of the endowment, aka in perpetuity. So an underwater endowment is just that. It is one that has gone under the total value of the corpus as far as its net asset value as you record it. Again, you've spent more for that fund than you have earned. This requires that organizations track their endowments at the fund level. And what this means often functionally is that you're tracking at the gift level. There are organizations, many of you may be part of this, where you might have an appeal or campaign for many donors to contribute to your organization's endowment. But the majority of what we see when we're looking at endowments is somebody has given you a gift with specific restrictions, specific requirements, and is sort of treated sui generis. So you have to track it at its fund level and make sure you're following the earnings and the spend on that specific gift. And that has a lot of challenges to it. And so you need to make sure you know at a gift level, has this fund gone underwater? I want to kind of walk you through an example of what this looks like, because it can be really hard to conceptualize. So let's say, all right, we're going to look at an underwater fund. Let's say the red line here over 7 years, this is what the stock market is doing. So some years it's up, some years it's down, some years it rebounds pretty radically. So there's a lot of up and down. Meanwhile, you have a $100,000 gift, right? So that's the green line here. That $100,000 gift is the corpus is supposed to always be the corpus, is always supposed to be the corpus. Now, what might happen is we're going to look at an orange line. If you have a spending policy that's 3.5%, what's this look like with this particular mix of investment returns? Well, you can see here it starts off strong, right? You're earning more than you're spending, so the value is increasing. And in year 2, it's almost 6% of the original. 106% of the original gift value, which is awesome. But then the stock market takes a dip, and if you keep spending at 3.5%, you can see around year 3. So right here, I don't know if y'all can see where I'm looking, but where the orange line crosses that green line, this is when your fund has gone into underwater territory. You're still spending at the 3.5%. And because it takes a while for the stock market to recover, it also takes a while for your endowment to recover. Now, this is important not only for tracking, but as we'll talk about in a little bit, this also means things for what you can do with some operating monies that you have. Because if you're underwater, you can't just stay underwater, right? You have to sort of make it right, even if that's just on paper, until the fund recovers. So you can see in this example with the orange line, if you stick with your original spending policy, 3.5%, and that 3.5%, as one of the questions was asked, this spending policy is the net value. So if you have $100,000 in year 1 and your spending policy is 3.5%, and you earn 5%, then you sort of net a 1.5% earn on the endowment for the year. If your endowment over time does really great because of investment returns, and you still have a 3.5%, you get to that chunk of the 3.5% increases as the total value of the gift, that is the corpus and the earnings, accumulates over time. Now, this is the orange line. You're kind of sticking with 3.5%. If, however, you decide, you know what, we're going to have an adaptive policy that's flexible, and for the first couple of years, you're sticking with 3.5% of the normal spend. But then moving forward, you realize, there's a dip in the stock market. We can't issue as much, or we can't spend as much from this fund as we were, right? You pull back some. You still spend to honor the donor wishes, but you maybe, instead of being 3.5%, maybe it's 2% or 1.5% until the fund recovers. And you see with that responsiveness, you get out of being in the underwater state. You're only there for 1 year, and you get out of it much more quickly. So it really highlights the importance of managing your spending policies. But if MIFA, really, this is the context of MIFA, requires you to track this stuff. You need to know when you're underwater or not, if you have overspent or not, and make sure that you're making it right to whatever extent possible. Now, there are some perks to MIFA. One of the things a lot of people liked about MIFA is that it allowed for the release of restrictions of small funds, particularly if there were long-aged gifts that were under a certain threshold. In a lot of states, that's $25,000, and were over 20 years old. And if those restrictions were such that it's no longer practical, or in some cases, it's no longer legal for you to fulfill the donor wishes, this allows you a mechanism for reclassifying those funds to meet a different aspect of the donor wish. We'll talk about that a little bit more, but there is a mechanism that means that very old gifts and very small gifts, you don't just have to sort of ride with those until, your organization comes to an end and you fold up shop, right? Okay. There are certain requirements, though, that MIFA has in addition to tracking some of those funds. One, you need to have an annual financial statement report and an independent audit. So if you're an organization and you're getting a review, or you're just not getting an audit, right, you are no longer compliant with a MIFA. So you really want to make sure you're staying up to date with your spending. There also needs to be routine review of policies and procedures. We'll talk about what some of those policies are momentarily, but this includes things like making sure you've got internal controls in place related to specifically your endowments, right? Good practice to have anyway, but nevertheless. There are legal and financial consequences of non-compliance. I'm not going to read them all here, but they can be bad, right? They can be catastrophic for some NFPs. If you lose your tax-exempt status, that can end a lot of organizations. Of course, there can be reputational damage. If there are civil or criminal charges, donors aren't going to want to give you money. And it may also mean that there are increased reporting requirements to ensure that you are now in compliance if you were previously not. Okay, so we're now to our third polling question. The question is, does your organization have an investment committee that manages your organization's endowment or endowments? So is there a group of people from your board that oversee your endowment activity if you have one? So there was a good question in the chat about whether a MIFA mandates whether you keep the corpus at least equal to the original gift, or are you required to keep up with inflation? That's a great question. As far as what MIFA says specifically, we can do some research and get back to you, but certainly a best practice is if you have a gift of 1980 in 1980 of $100,000, it's prudent policy to ensure that the purchasing power of that $100,000 in 2025 is equivalent to what it would have been in 1980. So as far as prudent management, do recommend that you have policies in place to ensure that spending power. Okay, great to see that the vast majority of you either don't have an endowment, cool, or if you do, you have an investment committee that supervises this, or at least you think so, right? So definitely a good question to go back to your boards with and say, hey, are we keeping an eye on this if you're not sure? Now, there are several common issues with managing endowments. So one is coordinating with development and fundraising. I don't need to tell a lot of the accountants in this training that sometimes you don't see things the same way as your fundraisers do. So there is a lot of work that needs to go into coordinating with development and fundraising, making sure that their gift acceptance policy aligns with what's required for endowments. So you're not having donors provide endowed gifts that the organization can't actually use in the way that the donor wants, or there's terms that don't really jive with what your organization is trying to do. So that can be a real headache if you're not on the same page from the get-go with your fundraising team. Failing to fully leverage tools. There are a lot of resources out there that organizations can use to track their endowments, but failing to use those effectively can really become a headache for a lot of organizations. Staff turnover and expertise gaps, right? You might have people who know how the endowments work today, but a year from now, those people may be gone or promoted, or just for whatever reason, may no longer be available to assist with your endowment. So making sure there are clear policies in place that survive people leaving and losing some of that expertise. There can be siloed systems, delayed reconciliations. So you might have a CRM that doesn't talk to your accounting system as far as what are your endowments doing. So you might not have, from a finance perspective or an accounting perspective, you may not have insight into what's going on as far as the donor activity related to your endowments. There are so often challenges with documentation of donor agreements. We've worked with organizations where they want us to look at their endowments, and we look at some of the documents and we say, you think this is an endowment? I don't think it is. Or even worse, if somebody gave a gift that should have been endowed and wasn't, that can really leave you exposed. So you want to make sure there is a single source of truth that everybody in your organization agrees upon regarding donor agreements, particularly for endowments, because those are supposed to be in perpetuity. So it could be you received a gift in the 1970s that was an endowment. You are still responsible in 2025 to ensure that you are compliant with the donor wishes and the different state regulations over those endowed gifts. Then, of course, keeping up donor-imposed restrictions, that's a challenge no matter if you have endowments or not, but it's even more so when you do have endowments and there are overlaps between long-age endowments and state restrictions, or you're tracking multiple funds, multiple donor restrictions, or you're just trying to figure out the balance between, we have an endowed fund that helps us meet certain restrictions, but that overlaps with other non-endowed net asset restrictions. Maybe they're doing the same thing. Where's the priority? And so it's really important to have clear policies there. And then board designated records. So this is, we're not spending a ton of time talking about board designated endowments in this because there are less regulations and requirements over the board designated endowments. Those are largely driven by organizational policies. Nevertheless, you need to make sure there are clear records on what decisions, what policies are in place regarding your board designated endowment, your quasi-endowment, so that people within the organization, the board themselves, can know, what are we supposed to be doing? What should we be doing? What do we have to do? Okay, other common issues with managing endowments. We'll just touch on these very quickly. Maintaining endowment spending power. We've already talked about this somewhat, making sure they don't go underwater. Tracking underwater endowments. This can be a headache. If you've got more than a handful of endowed gifts, it can be really challenging to make sure you're tracking them so that your spending policies and the returns on those endowments don't leave you in an underwater situation, especially if you're not aware. Because if you have a shortfall, you have a fund that's underwater, you have to, in the year that's underwater, you have to perform a reclass from your net assets without donor restrictions. So the ones you can use for all your operations, you have to make that right and reclassify some of those net assets without donor restrictions to these endowed gifts until your endowment recovers and is back above water. So it can really have an impact, particularly if you have significant underwater endowments. So it's not the end of the world if you do. Sometimes you have to. Circumstances require it. But nevertheless, you need to know it's not sort of a cost-free decision. Managing investment asset allocation. If your investment committee or your board that's overseeing the endowment is not clued into the investment asset allocation, if there's not clear policies in place, right, that can cause all kinds of headaches if you're not getting the kind of return that you need to. Similarly, managing spending policies, making sure that your organization is following what the set spending policy is, either set by the donor or by the board, but making sure you enforce that and that money is being released as it's supposed to be. A critical one is agreeing your investment activity to fund balances. Okay, so with your endowed gifts, you're getting money and you're investing it so that it has a return that you can use to fund your mission and support your beneficiaries. You should be able to, even if you have a really complex investment portfolio, you should still be able to agree your investment activity to fund balances. Now, we know that you might have net assets that are without donor restrictions that are included in your investment portfolio. Nevertheless, you should still be able to say, here's the return on our endowed assets, the assets we invested. You should be able to do that relatively simply and timely. If you don't, it can be a really difficult problem to disentangle. And then, of course, donor reporting is a critical issue. And like we talked about a few times already, net asset classifications, keeping all the lines straight. Okay. Now, there are a few best practices for endowments. You want to make sure there's an investment policy statement. So this is a set statement that talks about what is our spending policy? What do we do if there are gifts that are underwater or funds that are underwater? What is our investment asset classification? What is our risk tolerance for our endowment? Now, this is something that has to be determined internally by your board, but you do want to make sure there are people who are part of that conversation with the appropriate skills, knowledge, experience to provide that guidance. Again, what is your spending policy? What are criteria for spending decisions? So let's say you have a surplus in your endowed assets, right? When do you get to determine that can be released? Or do you save that until there's a rainy day? What does the donor say about that? There are a few other conditions as well, right? You don't have to set your spending policy to be the same every year. You can tie it somewhat to investment returns and have a bit of smoothing over time so that individual years where it's up or down significantly doesn't impact your overall endowment policy. And then how do you manage your underwater endowments? It's critical that you have internal controls, that there is oversight, that you have a clear spending policy that's reviewed routinely, and that you have controls over donor communication. Who's reporting to our donors on what the return is? And your donor, you do owe a fiduciary responsibility to your donors to let them know if they made an endowed gift, what is the impact of that? So a lot of organizations, it may be difficult to do this, particularly if you don't have the infrastructure in place to perform this reporting, but it is best practice to ensure that you're reporting at least annually to donors who have given you an endowed gift. Okay, there are a lot of tools out there. I don't want to spend a lot of time on this because the Google search will do about as much good as it will in this discussion. But right, the fundamental tool is clear and timely reporting. You need to have mechanisms in place that allow you to create detailed schedules of investment returns and allocations by fund, and also enable you to perform that annual impact report for your donors to know what is happening with the gifts they provided to you however many years ago. There's a lot of software out there. There's fund accounting software. So this is things like Blackbaud Financial Edge, Sage Intacct, QuickBooks Online. There's a whole host of things that a lot of accounting systems that nonprofits use or colleges use can also double as fund accounting software. There are also a lot of endowment subledger and portfolio software. So you may have heard of these. There's Fund Driver, there's Adavaco, Common Fund. We've had good experience with all three of these. And there are donor management systems that need to be integrated as well. So maybe it's Razor's Edge, Donor Perfect, any kind of CRM can function here, particularly if it's tailored for your organization, to just make sure you're keeping track of all the information, that single source of truth we talked about. There are a lot of other tools too, right? There's a lot of organizations that just use Excel, which again, depending on the volume of endowments you have, that may do exactly what you need it to do. But it may be you do need one of these softwares, and Cherry Beckert can assist with trying to determine what works best for you all. Unitization calculations, the second bullet here. This is basically just a way of saying, okay, for your entire pool of endowed assets that you have invested, right? You're investing them in a pool with a similar mix. How, once earnings are calculated on that entire pool, how do you allocate those to each of your funds? That's what unitization means. You need to be able to know how to do that. And then there are several resources out there. So NACUBO, National Council of Nonprofits, Center for Effective Philanthropy, these will often put out best practice statements on what's going on with endowments. And then also too, the software vendors we talked about, they have a vested interest in making sure that their customer base is aware of trends in tracking endowments, problems, pitfalls that they're seeing in the market. So do look to these resources if you need help trying to figure out which end is up. And then of course, there's folks like our team at Cherry Beckert that can assist with providing guidance on how to most effectively manage your endowment. And particularly if you've not been keeping up with staying on top of your endowments, it can be really hard to get there and stay on top of your day-to-day requirements. So that's where a team like ours can come in to assist. Okay, so the fourth polling question is going to come up. And the question is, how well does your organization align with best practices for endowments? So we didn't touch on all of them, but we touched on a lot of them. So which of these best describes your organization and its best practice? This is great to see. We love to see that the majority of you are doing everything you need to do. And then, yeah, the next largest, there are some policies you need to tighten up. That's excellent. So making sure that you know where the shortfalls are, or if you do have a lot of room for improvement, right? Making sure you kind of know what you're up against, right? How are you going to solve this problem, particularly if you have the opposite of best practices. Okay. The last poll is similar to other sessions, right? Would you like a team member to reach out to you today after today's webinar? So after this polling question, we'll have some time for some Q&A. I know there's some questions that have been asked in the Q&A chat that we can try to address. Let's answer this polling question first. All right, so I know one of the questions that was asked very early on was that underwater endowments, while we're waiting for these poll results to come up, underwater endowments for young universities continue to be a huge issue. How do we balance performance and expectations, yet keep sound diversification? This is a great question, particularly for universities that are still trying to get their footing underneath them for endowments. It can be really challenging to make sure that you're allocating those endowments to assets that are going to start getting returns. But the question is, right, if you have a lot of underwater endowments, how do you deal with that? The first thing is making sure there's clear communication with the board, that investment committee and whoever's providing oversight is aware of the challenges that are faced by managing these endowments, and just make sure there's buy-in from them, that they realize, right, there's going to be a lot of challenges in trying to get your endowments underneath you. All right, so another question, underwater applies on a pooled donor endowment or on a donor by donor endowment basis? Great question. So it depends on how the endowment was originated. So it's really back to the source of the fund. Was the fund we did a mass appeal and everybody pitches in and creates this endowment? If that's the case, then you're tracking that fund for whether it's underwater or not. But if you receive a specific gift, let's say you receive $100,000 for say mental health, right? It's restricted only to mental health services. If you overspend for those mental health services from the earnings, that fund is underwater. So we really don't see that there's, the entire endowment pool is underwater. Usually it's a specific fund that you're trying to pay attention to. So I hope I answered that question clearly. Not familiar with Bear, but if you're working with any organization and you're unsure whether they track underwater for you, that should be a conversation you're having and making sure that you are addressing that upfront and saying, we really need to know, are we underwater or not? So that definitely is a conversation you should be having. Another person said, right, we use CB for our accounting since we don't have an accountant on staff. Is there software that can help us get our endowment fund management without spending an arm and a leg? Yes, we know of at least one provider, and we're happy to make those introductions for you. That does provide. I often hear clients say it's shockingly affordable. They're very aware of the challenges for NFPs. And it can be affordable. And there's a lot of customizability too. Sometimes there are folks who will do the endowment tracking for you in addition to offering you software. There are others that give you the software, show you how to do it, and then you run it. But there are a lot of different ways that you can use the software in addition to accounting that, for example, Cherry Beckert or another outsourced form is providing you with specific expertise in the area that you need related to endowments. Are there penalties or compliance issues for underwater endowments? You need to know what they are, and you need to be able to make sure that you have other assets available to cover a shortfall. If you are consistently underwater, that may indicate there's imprudent spending policies in place, and that could result in penalties. Usually the kind of penalties we're seeing are for organizations that are being too aggressive and not really performing due diligence. Usually those kind of penalties are not from the result of, we're trying, but, the markets keep cutting our legs out from under us. So as long as you have a good faith effort and you have clear policies and a paper trail of decisions that are being made and why, that should help you stay clear of penalties or compliance issues for underwater endowments that are sort of not getting above water, but you're still operating sort of in good faith and doing your due diligence. That's a good question. Okay, another question that came in the Q&A. Do you think the new endowment tax and shifting public perceptions are causing organizations to rethink how much they rely on their endowments? That's an excellent question. I do think there needs to be clear positioning for organizations, particularly foundations. Those are the ones that are the real target of a lot of pressure coming from the federal government. And there needs to be a clear sense of what policies are in place so that you can basically ensure you don't run afoul of regulators or laws that are in place in your particular state. And then, yeah, there's one more question, and then I think we can wrap it up about we're researching starting an endowment. What things should we have in place before moving forward? The main thing that we see organizations needing is an investment policy statement. You need to know when you get that endowed gift, what are you going to do with it? How are you going to make sure that you are staying compliant with UPMIFA, that you're getting a return on your investment? And then similarly, I would say if you're put your partner up with your development team, make sure they have a gift acceptance policy in place that still helps you stay compliant, still helps you make sure you're sort of meeting all the needs for what is required for your financial reporting and local regulations. So those would be a lot of the main things you want to make sure you have lined up. But we have a lot of resources that can offer you some support as you're exploring that as well. Well, thanks everyone. If there are additional questions, because I know this is a really complex issue, reach out to Rob and myself. We're happy to help. We're happy to put you in touch with people who can answer specific questions you have, from everything to how to make sure our policies are what they need to be, all the way to ERPs and softwares and those kinds of solutions. This is challenging. You don't have to do it alone. We're here to help. So reach out if you have questions.
Thank you, Jason, Rob, excellent. Appreciate the presentation on endowments, and for sure there is a lot to absorb here. This concludes our final session for today. For those of you attending and have attended all day, we will have our second day of our Not-for-Profit Virtual 25 conference on Thursday, with our first session starting at 10 a.m. And we would again appreciate your feedback. You will receive an evaluation subsequent to this that will pop up automatically when you leave. And if you have any questions, Jason and Rob obviously provided their contact information. Feel free to reach out anytime, and look forward to seeing all of you on Thursday for our next day in this webinar. Take care, everyone.